Welcome back to the deep dive. Today, we're analyzing something huge happening in the financial world. Really, it's about this jaw-dropping institutional confidence in Bitcoin. And it's all centered on the world's largest, most powerful academic money manager.
Exactly.
So our mission is pretty simple. We've gone through all the quarterly filings, the market commentary, the analyses you sent us, and we really need to unpack what Harvard University's massive new Bitcoin position actually signals.
And this isn't just a big trade.
No, it's a statement, right? It feels like a statement about the permanent mainstreaming of Bitcoin.
It is, and it's so crucial to frame this correctly from the start. This isn't about, chasing momentum like we see with a lot of short-term traders. This is what we call long-duration capital. It's money managed for decades, not for quarters. And they're making a strategic, a public, and frankly, an incredibly aggressive commitment.
Okay, let's get into the numbers then, because they're pretty shocking. Harvard didn't just, buy a little. They used the recent market dip to drastically scale up their position in IBIT.
Which is the BlackRock Spot Bitcoin ETF, for anyone who doesn't know the ticker.
Right. So when the latest 13F filings dropped, and that's the mandatory report showing what the big institutions own Harvard's move was, it was the headline.
I really was.
They reported a whopping 257% increase in a single quarter, moving from 1.9 million shares to an incredible 6.8 million shares of IBIT.
And this is where the context becomes everything. That sudden accumulation meant that their position on the reporting date was worth almost $443 million.
Wow.
But what's really fascinating is that this single crypto position vaulted them to the #1 spot, the #1 U.S. declared institutional holder of that ETF.
And they surpass some massive players.
Huge players. We're talking about them holding more IBIT than institutions with huge positions in Microsoft, Amazon, and this is the big one, even larger than holdings declared by key investors in the massive SPDR Gold Trust.
That comparison to gold is the real signal here, isn't it?
It's the single most important signal. When you manage Harvard's $57 billion endowment, the largest academic endowment on the planet, you do not make a $400 million bet on a whim.
No.
This is a strategic allocation.
Right.
And it was executed precisely during a market correction. It's pure evidence of elite institutional belief.
So if we zoom out a bit, connect this to the bigger picture, Harvard's move isn't really an anomaly, is it? It feels like it confirms this idea that big institutions are now accepting Bitcoin as gold 2.0.
Precisely. For these sophisticated allocators, Bitcoin is checking boxes that traditional assets just can't anymore.
What kind of boxes?
Well, they're using it as a multifunctional hedge. So it's an inflation hedge, a treasury hedge against all the fiscal uncertainty, and it's that uniquely uncorrelated diversifier.
Right, and the non-sovereign store of value.
That's the big one. And this transition, it's generational. Look at the timing. We're seeing the first universities, the first sovereign wealth funds, the first major insurance treasuries, all jumping in within this really narrow 18-month window.
All because of the ETFs.
All catalyzed by the regulatory clarity of the ETF structure.
And that's where it gets really interesting, right? Why this sudden adoption through the ETFs? Endowments and universities, they famously avoid operational risk.
They hate it. And self-custody has always been a massive headache, a total no-go for any fiduciary board.
So what changed?
It all comes down to career risk, or the elimination of career risk and operational complexity. Endowment boards are conservative. They fundamentally hate operational risk.
But when BlackRock and Fidelity step in.
Exactly. When BlackRock, Fidelity, grayscale institutions they already trust with trillions of dollars step in, that risk just evaporates. The ETF is regulated, it's insured, and it fits neatly on their balance sheet.
And it fits their mandate perfectly. Endowments have that 20, 30, even 50-year time horizon. They are desperate for non-correlated assets.
And high Sharpe ratio opportunities. For you listening, the Sharpe ratio is just a measure of return versus risk. The higher it is, the better. And Bitcoin, despite its volatility, has an incredibly high Sharpe ratio over the long term.
So it offers those asymmetric returns they can't afford to ignore.
They really can't.
So by solving the operational problem, the new career risk for a chief investment officer isn't owning Bitcoin anymore. It's actually not owning it.
That's it. When you see giants like Harvard, Emory, and Abu Dhabi all making public filings, the peer pressure becomes immense. Missing out is now the real risk.
We have to talk about the current market, though. We know the price of Bitcoin pulled back recently, sitting around $96,000. But the institutional buying we're seeing in these filings, it was accelerating during the dip.
This is the definitive signal we have to ask. Who is buying and who is selling.
And the data shows.
The buyers are overwhelmingly long-duration capital. It's the Harvards, the Emorys, the sovereign wealth funds, the big family offices. They are strategically accumulating during this correction.
And the sellers.
The outflows are mostly from the short-term crowd, momentum traders, speculators who got in late, and people just taking profits after the run-up.
It's just, I mean, it's classic smart money behavior. Retail sells the panic. Institutions accumulate the fear.
Textbook. They think in decades, not months.
Right.
And they're loving the lower volatility compared to, say, 2017, the better custody, the regulatory clarity. Harvard didn't buy the all-time high. They bought the fear.
Okay, this is a great point to pause for just a second. Before I move on to how this whole trend could scale up, a quick note. If you're finding this deep dive valuable, engaging with the content, liking the video, dropping a comment with your thoughts, hitting subscribe, it really, really helps us support the channel.
It really does.
Yeah, it boosts our visibility in the algorithm, and it just ensures we can keep creating quality content like this for you. So we really appreciate you supporting the deep dive.
Okay, so building on that, let's talk scalability. Because Harvard's move is just the beginning.
Their current allocation is still pretty small, proportionally.
It is. It's about 0.6%, which is hundreds of millions of dollars, yes. But they could easily scale that to 1%, 2%, maybe even 3% over time.
And the ripple effect of that would be
Huge. Just look at the top 20 U.S. university endowments. If they all followed Harvard and just allocated 1% to Bitcoin through these ETFs, that single action would translate to an inflow of over $10 to $12 billion.
wow. And that's on top of the record-breaking ETF launches we already saw.
Exactly. This university money just accelerates that trend.
And we know Harvard isn't alone in the academic world. Emory University is another big one.
A key mover. They doubled their ETF holdings, a 91% increase, and now hold nearly $43 million. And they've been very public about how the ETF structure is just a safer, easier alternative for them.
But the sovereign wealth fund signal, that feels like the biggest indicator of true, government-level adoption.
Absolutely. The Abu Dhabi Sovereign Wealth Fund, the ADSWF, they didn't just dip their toes in. They dramatically grew their IBIT position from 2.4 million shares to almost 7.9 million.
And that's worth
a staggering $517 million.
And they're the first sovereign wealth fund to publicly declare this, right?
The first one to make a public 13F filing for a spot ETF. Think about what that means. A sovereign wealth fund is a nation's strategic reserve. This signals that Bitcoin is being adopted at the highest levels of government finance. The entire risk calculus has just fundamentally changed.
So when you put it all together, Harvard, Emory, Abu Dhabi, plus what we already know about MicroStrategy or even the early VC moves by Yale and MIT years ago.
You see the full picture.
Yeah, it frames Harvard's move not as a one-off, but as the final clear public signal of this global shift.
So what does this all mean for you, the listener? We are, I think, definitively watching the final adoption phase of digital gold unfold. The key barrier, that operational complexity and career risk, it's been completely solved by the ETF structure.
Which allows all this generational capital to finally flow in.
And they're doing it strategically, targeting these periods of market correction.
Which brings us to our final thought for you to consider. Given this level of public, strategic buying from institutions during a market dip, does this confirm we've likely seen the cycle bottom? Or is this just the very, very beginning of how high this could all scale as these funds move from, say, 0.6% to their more typical 1% to 3% allocations? Thank you for joining us for this deep dive into institutional conviction. We'll see you next time.